Okay, I'm going to do a Q&A. I'm going to do it a little bit differently this time. Just so that you know, I'm in the middle of live sessions for the Level 3 exam coming up in February, and I have sessions all week long, and next week it increases even more. That I find it hard to fit in the time. Doing it the way I did before by clipping the question, putting it on the white screen, answering there is really time consuming. So I'm going to just scroll and see how many I can answer here. Normally I take the name out, but hey, if somebody's commenting with their name, you can always see their name anyways. So this one here, the question starts down here. My question this week is if there is any problem with entering into a put spread or call spread at separate times to when the initial long position was entered, or is it more ideal to execute both legs at the same time? Well, it depends on what you're trying to get done. So when I am thinking about something like that, if I buy puts, I simply buy puts. I can always sell puts lower and create a put spread, but I buy the puts. So if the market does drop, the puts are making money right away. And if I'm really interested in the put spread, I can sell deeper out of the money on the put to get cash neutral. So that I can do better than if I set it up intentionally. The problem is if it goes up. Now, if it goes up, the short put that I would have had to complement the long put would have earned some money as the underlying was going up. But now that the underlying is going up, I only have one leg. It's actually just losing money. I have nothing that's offsetting it. But typically in situations like that, I would look to sell calls on the upside to get cash neutral. It depends on what it is you're trying to get done and how comfortable you are with entering in a short call or a short put position after you enter in your long call or long put, which then would create a margin requirement. With your short ES position, when would you close it out if it was to move against you and the market was to rally significantly? Well, whenever you have short positions on the market, you have to be extremely tactical. A short position is not a strategic allocation. By strategic, I mean it's not a long-term hold. It's very tactical. So if the market takes a dip one day and you can take some profit, you reduce your position. When the market rallies, you increase your position. As it sells off, you reduce your position. So last week, the market, the June ESs dipped all the way to 4,000. I took off half my position. It rallied back over 4,100. Again, I'm talking about the June ES contract, and I added them back on. So this is important to understand. If you're long, you have the luxury of time. You can take a strategic long position and hold it. If you're short, well, you cannot, because especially at the level of the index, because over the long term, the index goes up. So it's a very short-term, very tactical play. However, if the market continued to go up and I came to the conclusion that I was wrong, yeah, I would probably look to exit. What do we got here? About the curve inversion. I notice that historically recessions occur months after the inversion resolves. So given the depth of inversion, can we conclude that the recession that the current inversion is referring to will not be a 2023 event? Not really, because recessions are not determined by the economy. They're determined by a dating committee, and usually you don't find out for even if a recession happens this year, we're not going to know for a year and a half to 2 years what they date the start of the recession as. When we see a curve uninvert ahead of a recession, that's looking backwards. What you have to do is go to the point in time where the curve starts uninverting and look at some of the data that was coming out at that time. It usually was recessionary. And the curve uninverts, has always uninverted from these levels by the Fed cutting rates. So the Fed starts cutting rates because the data coming out is recessionary, but the recession has not yet started based on backwards looking data that will only happen 2 years from now. So when we look at these charts saying, oh, the curve uninverts before the recession, keep in mind that that recession was not dated until 2 years later. At the time that the Fed started cutting rates, the data was recessionary that warranted them to cut rates, but the actual dating happens later. Let's see, you brought up corporate bond issuance and the ability for the corporation to enter into a swap for pay fixed, receive floating. to take advantage of rates lowering. I think they'd want to receive fixed pay floating, because if they issue corporate bonds, they're paying a fixed coupon. So when they enter a swap, they want something to offset what they're paying. Since they're paying fixed, they'd want to receive the fixed, and then they'd want to pay a floating, not receive floating. My question is, during that type of environment where clearly the cards are laid out and the Fed is forced to lower rates, would it be a difficult task to find participants take the other side of the swap? Let's see, is there anything more here? No, it wouldn't, because these are OTC. You simply go to a dealer. A dealer stands ready to quote a bid and an ask on the fixed side of a swap at any time. So you can enter into a swap at any time, and a dealer desk will be on the pay fixed side of a number of swaps and on the received fixed side of a number of swaps, and a lot of them cancel out. And they have a net exposure that they then hedge out with interest rate futures or however they want to hedge out. But the dealer takes the other side of all these swaps. Does it make sense to use SPX options instead of SPY options for a small account to avoid assignment risk and the potential for a large margin loan? You would not use SPX. SPX is for 250 times the index. SPY is for 1/10 the index. If you're looking for European style options, meaning only last day exercise, options on SPY are American style, meaning anytime exercise. Maybe you didn't mean to type in SPX, maybe you meant to type in XSP. And if that's the case, then yes, you would use XSP, which equals SPY, which is 1/10 the index, but they have European style options, not American style options. Given the market is cutting capital market yields, is there any argument for the Fed to start discussing selling some securities to bring rates higher at the longer end, or potentially switching to that strategy once they pause on the Fed funds rate? Yeah, they could do all sorts of things. However, they've been very measured and by projecting out what they're going to do. So I think if they were thinking of doing something like that, they would project that out. They would discuss that. And I don't know that they would use that to get higher rates, because they'd be more concerned about a functioning treasury market as opposed to getting the higher rates. I think they would just talk louder and let the market know that they are way incorrect in their assessment of lower long-term yields. Let's see. It seems the credit market is somewhat complacent, and corporate credit risk spreads have compressed significantly. Well, complacent is a good word for the credit markets. They are unconcerned. Broad investment grade barely pays any premium above the 1-year T-bill at the moment. Less than 100 basis points, that's for sure. In a higher for longer environment, I'm favoring rolling default and duration risk-free T-bills over corporate bonds. To avoid any credit spread widening, yeah, I can see that. If we do finally have a recession, lower corporate earnings, higher unemployment. You don't need a recession for lower corporate earnings. You just need stagnation. So you can have a soft landing where the economy is growing, 0.5%, quarter over quarter on an annualized basis, growing 0.5%, and that can stay that way for a year and a half. In a stagnant environment like that, you would get something called an earnings recession, where earnings would drop to recessionary levels, even if the economy doesn't, because there's no growth. So you have stagnation happening, and when you have stagnation, you'll also get a lower multiple. I assume that the long end of the curve would drop even further, but the credit risk spread should widen. Yeah. Okay, I can see if you get a recession, credit risk should widen. Yeah, I can see that, especially on high yield. Maybe not investment grade to much of an extent, but high yield, yes. What do you reckon? Which of the two forces, long end of the curve versus wider spreads, will prevail, therefore pushing corporate bond yields higher or lower? Well, if you're looking at the risk-free rate, corporate bond yields will rise and fall with the risk-free rate, but that's not exciting. When we talk about corporate bonds, we're really talking about excess return, and that's the excess return above the risk-free rate. So what would cause the excess return to widen? In other words, the spread to widen. It is really dependent on the state of the economy, not so much the level of risk-free rates. So and it's very tied to credit risk. So if there's a big credit event that happens out of the blue, let's say an emerging market defaults that no one expected to default, it just so happens they default, or a significant company defaults that just came out of left field, nobody really expected it to happen. Because it was unexpected, the question would then be, well, what else don't we know? What else is hidden under the surface that we don't know? Because we didn't expect this and it happened. What's lurking beneath the surface? Credit would dry up very quickly and those spreads would widen very, very fast. For a recession, usually a credit event is enough to throw an economy into a recession. The more stagnant the economy, the higher you have rates for longer, the longer the curve stays inverted, the deeper the curve stays inverted, there will be some company somewhere that won't be able to roll over its debt. And that may start something, or it may be some emerging market country that no one anticipated. Okay, what's our next one here? Would you please be able to describe the role played by repo, reverse repo, and so far in the functioning of monetary policy? Well, that's a half-hour discussion to an hour discussion. That's a whole class. So it's not really a question with an answer, but you can try ChatGPT for that one, see what it will give you. But it's more of a seminar than it is a question with an answer. Let's see, you mentioned you like to enter risk reversals progressively. First you buy the call, then you let the market tell you the next step. If it goes down, you sell puts further below, and if it goes up, you sell calls. My question is, do you sell those puts calls at the same expiration you bought the original call at? Usually, or do you try to sell shorter expirations and roll out the shorts if they end up in the money? It depends. It depends on like, there's no easy answer for that to say, here's my rule. It just depends on what I feel like getting done. It depends on the shape of the curve. When you look at implied volatility and the term structure of IV, maybe there is, you can go out 3 months, and then from 3 months onwards, the IV curve flattens. Well, at that point, going out 3 months is sufficient. That I might match the calls and puts I do with 3 months. But maybe I might go out a year and then use shorter term ones. Maybe I'll just use all shorter term ones. There's really no rule. It just comes with knowing it so well that it just becomes second nature. That you can improvise and you just sort of get a feel for where you want to be. Let's see. A Trinity study. I have no idea what that is. I see reports talking about 3-month and 6-month annualized inflation being around 2%. This then indicates that inflation over the past 3 to 6 months is in line with central banks. Can you include these numbers in the next video? So Atlanta Fed, have a look at the core and sticky 1 month. I believe they have the 1 month, 3 month, and 6 month annualized CPI flexible and sticky. So you can have a look at that, and I'm not seeing 2% on any of them. I shouldn't say on any of them. On any of the core measures. On the flexible ones, sure, but on the core measures, I'm not seeing that. If you look at the volatility of month-to-month CPI, it's very, very high, which means the distribution of possibilities is very, very high. If you look at 3 month, its volatility is lower. 6 month, its volatility is even lower, and then one year has the lowest volatility. So it's the 1 year that the Fed seems to look at because of its low volatility. That if you want to be certain, you want a small distribution of possible outcomes, you would look at the 1 year. If you start looking at the 1 month and annualize it, you could say, well, look, inflation is gone. Next month you go, oh no, it's back. Next month, oh no, it's gone. It's actually deflation now. Next month, no, there is no inflation or deflation. Next month, it's back. Because it is so volatile, it's hard to take the 1 month, annualize it, and say, aha, look, here we are. The 3 month is better, but it still is higher volatility than a 6 month, which is higher volatility than a 1 year. But, I've heard statements like, the Fed's not even looking at this. They're not even, if you look at the 3 month annualized, inflation is gone. They're not even considering that. First of all, yes, they are. Okay, it's not like there's this whole group of smart people in a room only looking at the year-over-year number and they're missing everything else, and that they need to be things need to be pointed to for them and say, oh, but you didn't see this and you didn't. They are well aware of that. They are well aware of all those numbers. Because they're choosing to use a specific one, that's the one that you would measure the intention of monetary policy against. They keep pointing to the same little group of numbers they look at. They're telling you exactly what they're looking at and what's important to them. They are not unaware of everything else. I've heard some commentators say, they're not even looking at this. Yes, they are. Yes, they are. They are looking at all of it, and they've come to the conclusion out of everything they look at that these ones seem to have the most salience for what they want to do. So they're aware of this. It's just if they're not saying something about it or paying attention to it, it's not because they don't know it. It's because it doesn't enter into the way they're thinking. And you can't say, oh, well, they don't know what they're doing. They know exactly what they're doing. Okay, they are not dumb people in that room. They're not politicians, so we know they're not dumb. These are positions of merit. They didn't win some popularity contest to be there. These are positions of merit, so we can have more faith in your central bankers than you can have in your government officials. If they're not talking about it, it's not because they don't look at it. It's because they are aware of it, but it's not important enough for them. It's too volatile. It's too high frequency, whatever the case is. Let's see, I'm level 3, struggling with convexity and duration. Okay, that's a level 3 question. We'll just pass that. I'm puzzled by recent USD weakness, having dropped over 10% within 3 months against other major currencies. I understand the market is pricing in the end of rate hikes by the Fed, but there's no way the other major central banks will continue hiking on their own after the Fed is done. So whenever we are trying to figure out the direction of any asset price or anything for that matter, it's always about the future. It's never about today. So if you say, but interest rates in the US are higher than interest rates in Canada, so shouldn't the US dollar just be getting stronger and the Canadian be getting weaker? And that's not really what they look at. The market says, okay, well, what is the direction of interest rates in the US and what is the direction of interest rates in another country? And it is what they expect to happen over the next 6 months or next 1 year that the market starts putting into play. If you're looking at the value of a currency as being primarily a function of interest rate differentials, maybe at times it's a function of purchasing power parity. Maybe at times it's affected by foreign direct investment and capital flows into and out of a particular country, regardless of the interest rate differential. So there's never just one thing that determines which direction that you would go in. Many people investors are suggesting that given the significantly deeper sell-off in European equities over the last year, way more than what the fundamentals would suggest today, that being in Europe is a better place than being in the US as far as equity investment. Well, capital flows will go into those markets. So that has nothing to do with the interest rate differential. It just has to do with the risk premiums that exist on European equities versus US equities. We can't just look at one, especially with currencies. You can't just look at one thing and say, but this one thing says something. Yeah, but it's a constellation, and it's always forward-looking. I think I got everything here, right? On top of that, U.S. has been, okay. Is there a problem to use dollar delta beta in a portfolio of some fixed income ETFs, which betas are close to zero? No, I don't think so. I mean, if it's close to zero and you're trying to get your beta exposure down to zero or to a particular level, no, I don't think it matters, because if I have dollar delta beta of 10 million and I add a whole bunch of fixed income and my dollar delta beta is still 10 million, well, it's still 10 million. I'm trying to manage that number. On your macro top-down applied series, I'm getting a nice view how to position the portfolio for each phase of the business cycle. However, my portfolio construction leans more to a binary scenario. Either we'll have a contraction or not. How's the best way to construct a portfolio for probabilistic scenarios such as 60% for a contraction, 30% for low growth, 10% for soft landing? You just did it. 60% for contraction. What stocks do well in contractions? So you find a number of equities that you would like to own in a contraction. In a contraction, interest rates drop significantly, so financials do very well, and mortgage REITs do very well. So you can be in those particular types of sectors that do well in contractions, or at least hold up better. You say 30% for low growth environment. Well, what does well in a low growth environment? Some things still perform or will outperform, and some things will underperform significantly in low growth, so you don't want those. So you can still construct a long only portfolio that appeals to different types of scenarios. I wouldn't say, well, I should be 60% short and 30% neutral, 10% long. I can still have a long only portfolio where 60% is appealing if we have a contraction. I've been unsuccessfully trying to find the speeches for all the Fed board members. Sometimes they post them on their particular Fed site. Sometimes they don't. So it's not that you'll always get them. While I'm down with becoming the best retail trader I can be, I also want to improve my skills as an equity analyst. I live in a small Canadian city with few prospects for working in the space, so getting trained at an ER shop is unlikely. Would you have any suggestions on getting strong at researching and writing proper professional reports aside from scouring the internet for reports? Well, you start, right? And usually the first thing you do is not that good. But then you stay with it and you say, well, I can add another bit here. And rather than just forecasting sales out linearly over the next 10 years, I can look at how the industry is expected to evolve, and I can forecast my sales that might be non-linear according to the industry. And then you say, well, if industry sales are going to grow in a certain way, is there a certain mathematical function that could describe it, where your Y variable would be log sales, for example? What would forecast log sales? Has anything in the past forecasted log sales? And you might find a couple of variables, maybe a couple financial, couple economic, that does a good job of forecasting one period ahead log sales. And from there, you fine tune it, you develop it. But your first pass is going to be rather naive, such that, a year later when you look back at the earlier work you did, you hope nobody saw it, because you say, oh God, that's embarrassing. I hope nobody saw that. It was like the first paper I wrote, year one paper in my PhD. When I looked back on it years later and I read it, I go, oh my God, that was embarrassing. I hope nobody saw it. It's like, obviously it was so naive, and you could tell that it just didn't have the polish of expertise or experience behind it. But you start by starting. But I will say this: if you're in a small Canadian city, you're out of the way. You got to get in people's way, which means eventually, at some point, you're going to have to migrate to where the financial center, happens to be. Maybe you're thinking about a work from home thing. I don't know that is a good way to position yourself. I'm not sure that a work from home is an entry level position, but somebody who's been an equity analyst for a company for 15 years, who has a demonstrated track record of producing output and being right, probably has earned the possibility of working from home. But until you prove that you can actually do something, working from home is, when I see that, I say, okay, well, so you don't really want a job, you want a paycheck. And I'm going to pay you full-time wages for what? Part-time effort? I mean, I don't know you, and you're asking me to trust you 100% with this work from home business on day one. I can't see you. I don't know what you're capable of. I need to baseline your output. How can I possibly baseline your output? So you do a report once a month. If you were in the office, would that be every 2 weeks? I don't know. You see, so I would say that, if you're in this small Canadian city with few prospects, you have to ask yourself some serious questions about what you're willing to do to get to where you want to be. Because sitting around saying, no, the company must be willing to bend for me. Well, who are you, right? Who are you that the company must be willing to bend for? You must become someone first, and then companies will be willing to bend for you. You closed some ES and waited for the mini recovery to take out more contracts. Were these moves always your plan, or did something you saw prompt this? Oh, sorry, I closed that. As I said earlier, if you take short positions, especially short positions on an index, indexes don't go to zero, okay? And you're not going to get any kind of accounting scandal at the level of an index, or any kind of regulatory short at the level of the index. You're really you're betting on weakness. Weakness has to show up, or you're betting that margins are going to contract, or you're betting on some big macro theme. You must be very tactical when you're short. You don't have the luxury of sitting around with a long-term hold. So there are days where the market goes up. You got to be willing to add to that short position if your conviction is there. And there are days where the market goes down, then you can remove some of those positions. So, if you short the market at a particular price, your closing price is the price you opened. Well, that's not going to always be your closing price, because you'll add more, subtract some, add more, subtract some. So your average price will always be moving around. So you must be tactical. You must be willing to overweight the position. So let's say that you want to be short 5 contracts and the market is moving up. You add your first 2. It moves a little higher, you add another one. It comes down, you see an opportunity to take the one off and break even on that. But the end result is that you've raised the average price of the first 2 you open. You would do that if you say, yeah, the market's selling off, but not with the weight that I thought it would. So you get a feel for the market after a while that I don't know that the market's ready to go down just yet. This is just a morning reversal. So last week when the market, the June ES contracts, they got all the way down to 4,000. I didn't feel it. Even with that sell-off, it just felt too orderly, and it didn't have the flow. Because I can see the trades going by. You can put up spine, you can watch the speed at which they go by, and it just was, I don't see it. I'm not feeling the urgency here. So you feel the market from day to day. Now, if the trades were flying by and volume was elevated by 20 or 30% on the way down, I wouldn't have closed at 4,000. I would have waited, because that would have felt right to continue the short position. That just takes experience over time to sort of feel how the market is doing and know that, well, this is not where I want to get out, but I'm gonna get out here, and I'm gonna get on a little bit higher up. Could you please discuss your thoughts on zero level of gold reserves held by the Canadian Central Bank? Also, other advanced economies such as Germany, France, UK seem to have dwindled their reserves during the early 2000s, while Russia, China, and India have increased theirs. Looking at data from World Gold Council. So for that, I would say, why don't you tell me why you think it matters? So let's say the Canadian Central Bank has no gold. So what? Why would it having no gold matter to you? Some countries have different cultures that see gold as something else. Others, especially in the Western Bloc, feel that their version of capitalism seems to be the dominant version of capitalism, and every other country seems to be trying to emulate that to some degree. Maybe countries that don't feel that they're part of the Western world feel that there's safety in gold, and those that are part of the Western world feel that what was the point of all that gold anyways? So, it would seem to me that if you have a question about that, the first thing that must be answered is, number one, why do you even think it matters? And if you can't come up with any reason why it matters, you've kind of answered your own question that the lack of it can't possibly matter then. A few questions in my mind. Hope you could comment. Would you say the Fed is dominated by the coast versus the central area? As the decision is voting, would the coast overrepresent? Well, this is not politics, so I don't think we can. I don't even think we even have to think about that. Similarly, would you think the net worth data is also overrepresented by coast areas? Would a breakdown data be better? Why would it matter? I guess population is overrepresented by the coastal areas, so I don't know that would matter. I'm net short as well, but I'm not able to get the trading promotion for ES. Would you be able to share some tips on how to get that? The trading promotion for, I don't know what trading promotion is. Maybe my capital is too small. Could be too small, or maybe you're just not approved for trading options. You do have to answer some questions about how many years experience you have, and if you say you've never traded options or futures before, sorry, I said options earlier, futures. If you said you've never traded futures before, they're not going to let you at all. You must first tell them that you really know what you're doing, so that if you mess up, you don't sue them. And if you do sue them, they say, hey, this guy said he knew what he was doing. He lied to us. What can we do about that? But he said he knew what he was doing. Or maybe your account is too small. I think the margin for ES is somewhere, well, on a Canadian basis, somewhere around 12, 13,000. Let's see. Quick question on volatility and options. I understand how put options get more valuable as the underlying goes down and VIX goes up. VIX potentially goes up. It doesn't necessarily mean that as the underlying goes down, volatility goes up. The underlying can go down in a very orderly fashion. And volatility can actually drop at the same time, as long as the moves per day are within, if the moves per day are within one standard deviation, and when you look at all the daily returns are like within one standard deviation, you can have a nice slow bleed all the way down 800-900 points if that's how it happens, and volatility would still continue to drop. Usually if markets are going down, they go down at a speed faster than going up. That's why the VIX tends to go up most of the time, like 70% of the time. In terms of volatility premiums, is that the same premise for calls? Calls will do that. Calls will increase in implied volatility as the underlying goes up at the level of the stock. It's very rare at the level of the index. Not that it can't, but it's very, very rare at the level of the index. So there we go. Let's see. What's your take on GM planning to invest $1 billion in manufacturing a new V8 engine and going with hybrid setups? Recently announced Corvette E-Ray rather than pushing 100% EV. Well, you know, there is a growing concern among auto executives that if everybody tries to get into the same room at the same time, everyone will fail, because there simply isn't enough battery material being mined today, and nor is there a timeline such that you would have enough mines by 2030 for every car company to hit all its goals. Can't happen. It just wouldn't happen. The growth of EV will be constrained by the speed at which you can get these things out of the ground. And the video I did earlier in the year saying the ice age is far from over, I do believe that because of that constraint, ice will be with us for a very long time, another 20 years. A lot of these states and countries that have put 2030, 2035 as their limitation, many of them are going to have to carve out exceptions for certain things, or move them further up the channel from 2035 to 2040 or 2045. So investing in these capabilities at this point probably makes sense, because, you know, if you think, well, look, we've got another 10 or 15 years of this, well, there you go. There's plenty of runway there. Let's see. I think it's quite clever because mass-producing reliable small blocks V8 is where GM has, at least historically, a competitive advantage, and ICE isn't going away anytime soon. And GM reports this week coming up, and Ford reports this week coming up. So it's going to be interesting, especially their guidance. Let's see. You had mentioned in your weekly update, as well as the Applied series, that you are bullish on housing sector because of chronic underdevelopment in the past decade after the financial crisis. In addition to owning REITs, what are your thoughts about owning a rental property to gain exposure to the housing market for a small individual investor? I disagree with it entirely. You can get a ownership of the best apartments across all the cities in a particular country with professional management and get your rent check on the 15th of every month. You buy a property and you rent something to an individual tenant. You have huge concentration risk in that one location and in that one tenant. And let me tell you something, having been in this business before, it only takes one bad tenant to wipe out 3 or 4 years of gains in rental income. It only takes one bad tenant that either decides not to pay, and hey, they got rights. You can't just kick them out. And if you do kick them out, it does take time to kick them out. And while they're being kicked out, and they know they're going to be kicked out, they're not going to be friendly to your flooring, to your plumbing, to your electrical, to your walls, to anything. The amount of money you'd have to spend to fix any damage. And listen, if they're not going to pay the rent, they're not going to pay for damages. Good luck finding them. It only takes one bad tenant to mess it all up. When you can easily get exposure to a REIT and get your rent check on the 15th of every month. One specific name in the REIT sector which you are bullish on is CAR. In their Q3 investor presentation, their same property occupancy was 98.8. You'd mentioned some REITs suffer when their occupancy is already at peak. With that logic, what are some of your reasons to stay in CAR? Because they have their depreciation is very large because they tend to have newer properties. And when the depreciation drops to a certain level, they tend to sell those off and then they invest in new properties, such that their dividend payout ratio ends up being very low. So they've got a lot of internally invested funds. Because remember now, they have to pay out over 90% of their taxable net income. Well, depreciation, if you have a big depreciation shield, you can get your taxable net income to almost nothing. So even though they're paying a dividend based on that idea, that 90% taxable income, their FFO and AFFO are significantly higher, which means they can retain a lot more of their earnings without continually having to issue stock to continue to grow. That's a problem with a lot of REITs. Is, they start doing well, their price starts going up, and then bang, they hit you overnight with, oh, we're going to do an equity issuance for $87 million. It's already pre-sold. It's already a done deal, and you're not going to know about it until you wake up in the morning and the stock is down $1.20, right? ABR does that a lot. That's the one complaint I have about ABR is when they start doing really, really well, it's like, well, any day now they're going to issue more stock. So CAR is a little bit better in that respect. And I also believe that CAR has a stock buyback in place. I think they do. I'm curious to know how sentiment was in 2000, 2008. Was the recession as widely anticipated as it's today? 2000, not so much. The big thing in 2000 was the death of .com. Fortune magazine even started the year 2000 with the .com graveyard, where they had an obituary section for .coms, and every week they reported how many .coms had failed. And that really started to accelerate that year. I think by April, it was like, every week you heard of 2 or 3 of these .coms fading away. What really did it was September 11th. 2001, that caused some grief overall, and I think that sort of hung for quite some time. The recession wasn't deep at all. It was fairly minor, but you were coming off the explosion of a significant asset bubble, so that money was very reluctant to go back into the market, and it just had this slow bleed for like 2.5 years. I think down 60% from its peak. Not Nasdaq, but S&P. Because it had some components of that frothiness in there. I mean, when you think about Dell and Microsoft and Cisco, which were selling routers for the internet, it was all the thing, right? And then that whole tech thing came into question, and there was some real, like 2003, 2004. There was some real conversation whether or not Silicon Valley was still a thing. For lease and for rent signs were everywhere, and it was a question of, well, is this the end of Silicon Valley? It's kind of dead. Nobody wants to go there anymore. There's nothing happening, and it was a big thing. And then, well, it is what it is today. 2008 was different. It was about the subprime crisis, and it was, credit was so easy to get. I mean, you were being mailed credit cards without even applying. You were being mailed a credit card. And I was living in Cleveland. I think I was still in Cleveland up to the end of 2006. And then I moved to Canada in 2007. So I had that American experience. You get mailed a credit card, and all you have to do, 20,000 limit on it. I got mailed one time. It was 2,500. And I called to say, I didn't want this thing, that you may as well just cancel it. And he said, why don't you? I said, well, 2,500 doesn't do anything for me. I mean, that's just too small a number for me, so I don't want it. In the same call, raised it to 20,000 without anything. Just said, how's 20,000? And I said, well, okay, 20,000 allows me to do something with it. And it was so easy to get. So it was a lot of. The $4 gasoline was the thing that everyone was talking about. How can this go on? Look how much it costs to fill this, fill that. But it wasn't, other than that, there wasn't this, I guess I could bring it down to this. If you had a job and you were safe in your job, there is no recession. If there is a recession, it's other people, not you. So, until you have to start worrying about where you work in your job, there's no recession. So, no, it wasn't really that bad. And even after, your Bear Stearns and your Lehman moment, the market still rallied into the end of the year. I remember being on a ski hill New Year's Eve, or for New Year's Eve, and there was a trading day before. I'm at the top of the hill, and I thought, wow, let me just check in. I still had a BlackBerry then. I was looking and going, I can't believe this. It's still going up. It was unbelievable, because I was short. And it's kind of like it is right now. The excessive optimism and just hope, because the market really is got a large net long bias. Everybody who's got their money in 401ks is long. Everyone who's got any kind of tax-free account or RSP account or brokerage account tends to be long. Pension funds long. Institutional investments long. Endowments long. Foundations long. It is generally a long, like by a country mile, this is a long-only world. So there is always this hope and this belief that it's going to work out, because if it doesn't, what am I going to do? Because for many dollars that are invested out there, being short is not an option. So there's always that optimism that, if the market is going to go down, it must prove that it's going to go down. So, for example, you can believe that a company is going to the moon, and that's all you need. You don't even need evidence that it's going to the moon. You just believe that it's going to the moon, and if enough people believe it's going to the moon, it will start going up. But if you believe it's going to zero, unfortunately, most of the market's going to want evidence that it doesn't start heading towards zero just because there's a belief that it's heading towards zero. I need evidence. Look at Bed Bath & Beyond. Bankrupt. and their stock was rallying for a while, and it's like, how much more evidence do you need? Tell me. But to go down, to be short, you know the evidence must show up. It's not enough for everyone to believe that it's going down. The evidence has to show up. And that was the same in 2000, 2008, is even when the evidence was showing up, unfortunately, there was still this long bias that, no, the worst is behind us. Everything is going to be better now. Not only that, I have private investments, meaning that I have money with fund managers because, you want to be diversified across strategies. And we're in some funds that are 100% invested. They don't sit on cash. So one fund is a global small equity. There's a number of different funds, but I think I got like 30% in global small equities across a number of different funds. Well, they're 100% fully invested at all times. It has to go up. They don't take short positions. They don't sit in cash. It's all 100% long. So there is that bias to going up. That's a long answer, I think, but I think you can bring it down to all you need is hope to go up, but you need hard facts to go down. Let's see. Why would someone enter the other end of an interest rate swap, agree to fix for floating? Oh, I already answered that. It's the dealer, and the dealer does not care. Quotes both a bid and an ask for the fixed rate. What are your thoughts on the direction of the equity market in the context of how many portfolio managers and investors are defensively positioned right now? I have trouble finding a good measure of it, but lots of reports of high amounts of cash on the sidelines. Is there? I don't know that there's ever been a time in the market that no matter what is going on, I haven't heard, a bullish argument trot out the regular excuses all the time. There's a lot of money on the sidelines. Hedge funds are underperforming their index. It just seems no matter what is going on, somebody comes out somewhere and says there's a lot of money on the sidelines. Well, maybe that's where it wants to be. There are things called money market funds. That does not mean it's money on the sidelines. It means it's money in cash. So I'm a large multinational organization that has 1.2 million employees, and I have payroll every 2 weeks. I'm not going to let cash just sit in my bank account for 1.2 million people every 2 weeks. I'm using money market accounts. I'm using money market securities to earn a yield. That's not money on the sidelines. That is money that is strategically placed there for a reason. It's honestly, I don't think that I've ever, in all the time I've been doing this, not heard, regardless of the type of market we've got, somebody coming out at least once a week saying there's a lot of money on the sideline. Hedge funds are underperforming their benchmark as to reasons why we need to go up. It's kind of like, in real estate marketing, if you ever go for your real estate license, there's a marketing course, and there's only a couple of things that you learn, and you say no matter what, whether they're true or not. When you're showing a house, you say, this is a highly desirable neighborhood. It's never been a better time to be a buyer. If it's not a highly desirable neighborhood and everyone can see it, you simply change it to, this is an up-and-coming neighborhood. It's never been a better time to be a buyer. That's it. You pass. You've got the 3 lines that you say. Now, no matter what's going on in the economy or the housing market, you say, everybody say it with me now, it's never been a better time to be a buyer. If you're long only and you're trying to tell everybody that they should buy, repeat after me. What do you say? There's a lot of money on the sidelines. Hedge funds are underperforming their index. There you go. You pass. You're a salesperson. Now get out there and sell. Yeah, I've heard that. I can't even tell you. Listen next week. Somebody will say it. Tune in 10 years from now, and somebody will say it. Tune in 5 years from now, and somebody will say it. Review the archives from 5 years ago, 6 years ago, 7 years ago. You'll hear it almost religiously once a week, like church. What's your take on BDCs or BDC ETFs as potential income factories? It does seem like there's some structural. I don't know. Haven't really looked into any of that. For high net worth individuals, why invest in small caps if you can get in PEVC? Small caps, anytime liquidity, really. PEVC, 10-year lockups. Like, you're not going to get your money back for 10 years. It's illiquid. And if you do want your money back, huge redemption discounts. Could you elaborate with an example on the production stage of PP? Oh, no. That requires a whole seminar on how to do that. And I think I walked in one of the previous market outlooks from like months ago. I walked through a PPI. Questions about bank earnings. Not my forte, but I'll try. I understand that the level of credit loss provisions for Goldman Sachs, Morgan Stanley, still below pre-pandemic levels, but is an increase this substantially large year over year, something to be concerned about. Well, yes, it is increasing. There's no doubt about that. But when you're increasing from a small amount, like let's say last year you made a dime and this year you're going to make $1, pretty pathetic, but it's 1,000% increase, but still a buck. That's the best you can do is a buck. So at small levels, these percentage increases tend to look really, really big, which means you got to kind of discount that, because it's just such a large percentage, but it's such a small beginning that you started with, but they are increasing. So the question is, are they increasing? And it's a trajectory like a ship on an ocean that just doesn't stop on a dime and then turn sideways, but that overshoots. Are we going to overshoot? Is this the beginning of something more, or are we just reverting back to some mean level? Don't really know at this point. You think Goldman and Morgan Stanley's exit from consumer-based lines of business can be taken as negative corporate outlook on the consumer? No, just that they probably don't have the network and the expertise to be there. Listen, for most banks, and I think any banker will tell you this, the retail consumer that has their debit card and their little checking account are unprofitable. They're really not. They're break even at best. What you're hoping for with these customers is that you're going to get their retirement investments. They'll invest through your platform, that maybe you can direct them to your insurance arm. Maybe they'll get their mortgage through your bank. Maybe they'll get their auto loan through your bank. They'll have your credit card. But as far as the customer walking in the door with an account with no credit card, no mortgage, no nothing, they're losers for the bank. Which is why, years ago when you walked into the bank, there was always, when you went to the lineup, you'd be confronted with that bank employee who would show you over to the bank, the ATMs, and show you how to use them and say, you can do all your banking here. There was a big push for a long period of time to get you to stop standing in line so that they could stop, putting tellers there and that you could just do your own banking yourself. Rather unprofitable overall. Unless you can do it at scale and efficiency, which means you need probably years of building that up to get to that point. But 1 year ago, inflation was mainly supply induced, and raising rates wouldn't help anything but damage the economy. Meanwhile, your view on Fed policy has probably changed, primarily because the wage inflation is now into consideration. Well, that is still a supply problem, right? You have a very steep supply curve when it comes to labor. If you're trying to hire even just 1% of the labor force, you will shoot wages up significantly because there just isn't the supply of labor that you need. So it's still a supply problem. Raise rates 200-300 basis points higher from here, that's not going to solve the labor problem. You need either higher birth rates and a 20-year waiting period, or you need massive levels of immigration right now, or you need a whole bunch of people who are not in the workforce to say, okay, all right, I'm coming, I'm in. So it's still a supply issue. I have a hard time understanding the miners' copper rally over the past 3 months. My understanding is that copper prices typically decrease before during recessions. Structural shortage in things like aluminum and copper right now. So you do have a shortage, and an electric vehicle takes 3 times the amount of copper, 90 pounds as opposed to 30 pounds. Housing takes a significant amount of copper. I think it's like 250 pounds per house. And if you're going to electrify the grid, huge amounts of copper, because that is the fastest conductor for electricity. Electrons travel through copper wire at half the speed of light. Nothing is faster. So the amount of copper that you need on a going forward basis is way beyond the capacity of mines today to produce, which means you need more mines, you need higher prices, or you need to change your idea of how fast you want to electrify the grid. But you can't say we're going to electrify really fast and we want low copper prices. You're not going to get that. It would be great to hear your thoughts about Intel and or Goodyear as an income factory. Intel, after their earnings, I don't know that I would touch them. Goodyear is interesting because their volatility is quite high, in the 40s, almost 50%. And so they're sitting around $11, $12, with the options sitting around 50, 60 cents at the money. So if you combine the two, if you're looking for the short straddle, the February short straddle pays about $1.20 on like an $11, $12 stock. It's 10%. That's pretty good, and it seems fairly well supported down around the $8 to $10 range. So the downside doesn't seem that bad, and it's not as if tires are going to go away. And for electric vehicles, my understanding is that the tires wear out much quicker, or you need a much more expensive tire to get that done because the weight of the vehicle is significantly more because of the battery. So, I don't know if that is an opportunity for tire manufacturers or if that is a threat because it's going to be much more costly to produce those tires and they may not get the price they need. I don't know. I haven't really gotten too much into the tiers, the auto tiers, with tires being one of them. Is there any concern regarding the U.S. debt ceiling affecting financial markets? Only on the supply of treasuries. So if you hit a debt ceiling, well, then that's it. You're not going to increase the level of debt, which means the amount of treasuries out there in terms of dollar amount are constant. So when you redeem, since you're at a debt ceiling, if you have $1 billion that you got to redeem, you can issue $1 billion to redeem the $1 billion. You just can't exceed a certain level. So the size of the treasury market cannot increase, which is going to be a supply issue. And if you have a supply issue and you have funds that need to be in treasuries to begin with, for immunization reasons, for risk-weighted asset reasons, for whatever the case, you're going to have to push the price of those treasuries up because they're not going to grow at the same size as the market for treasuries would grow because of that debt ceiling. Is it U.S. politicians providing noise pollution? Well, anything that's going on these days is always politicians providing noise pollution. So yeah, it is that too. Read more. Innovator ETF released 2023 investment outlook paper, and on page 2 they show a chart that details how on average unemployment starts to rise about 2.5 years after the first Fed hike, and peaked around 2 years after the last hike. Okay, so these are averages. You got to be very careful about averages because an average comes from a distribution. So once we see a number, it is a number. However, before we see the number, there could be a number of outcomes that could happen because every data point is a random variable, and that random variable comes from some distribution. So rather than saying it comes up, 2.5 years before this and 2 years after that, I'd rather it be written in terms of it comes, anywhere between 6 months and 37 months before, and anywhere between 3 months and 29 months after. Give me the range, not just the point estimate in the middle of the range. I need to know the distribution. Without the distribution, that's the problem with averages. You get tied to a single point in that distribution. You think that's the number, but that is the middle of a distribution with a probability distribution in between there. So if we think about a 95% confidence interval, Well, it could be that anywhere from 6 months to 32 months is no different than the middle of the range if we did a 95% confidence interval test to whether or not 3 months or 9 months is within that range. We might find, yeah, there is no significant difference between that and the median. Well, without the range and just point estimates, it can be extremely misleading into thinking, look at these time zones. We got lots of time. Well, no. What is the range of possibilities? That's a little bit better to look at. Okay, a couple more, and I'll have to wrap it up here. When you buy put options, then wait to sell a call or a put, depends on the move. On half of the put options, is that called a risk reversal? If I buy puts and then sell puts, that's called the put spread. If I buy puts and then sell calls higher up, that would be called a short risk reversal on half of them. And do you mean selling half the number of contracts but the same price you pay? Or you sell the same number of contracts but half the price you pay? There's no real rule. I'm looking to get cash neutral, but I'm not going to do that in one move. Sometimes it takes 2-3 moves to get that. But if I can get it in one move, then yeah, I'd look to get it at the same price. For example, I bought 2 SPY 400 puts at 15. If it rallies, do you find some 425-ish call options, sell 2 at 750 each? Or do you sell 1 call option at 410 for 15? Well, it really depends on what I'm trying to get done. I know that whenever you're listening to the answers for option questions, you're probably getting a little tired of me saying it depends on what I'm trying to get done. But it does depend on what I'm trying to get done. So if you give me a toolbox and say, well, what tool are you reaching for? My answer would be, well, it depends on what I'm trying to get done. There is no easy answer for that. It just depends on what I'm trying to get done. You've mentioned recession probability as a function of depth and duration of yield curve inversion. Did you come across any research out there on the length of a recession and the depth duration of inversions? So yeah, there's lots of numbers that show, what are the average days when a curve is inverted, what's the average number of days, what's the average duration. But again, like I said earlier with averages, that's just an average. What you would rather have is a distribution or at least some tail component of the distribution. By a tail component, think about it this way. Whenever we see the 3-month to 10-year curve inversion and the 2-year to 10-month curve inversion, and they've been inverted for 3 months or more, there has never not been a recession. Never. So if we don't get a recession this time, this would be the first time. So the odds are against you. If you look at a number of different curve inversions, whether it's the 18-month 3-month forward less the 3-month, the 1-year forward rate minus the current 1 year. All those inversions have 100% probability. So there's not just one curve inversion, but many of them that are saying, we've never not had a recession, and now you've got so many of these inversions saying the same thing that, to say, well, what's the average length of a recession? I don't know that I would put too much stock in it. I would want to know what is the variation in recessions in terms of longest to shortest, so that I have some idea of the distribution of possibilities as opposed to just one point estimate. What do you think about holding short SQQQ to short the market? If this is a levered ETF, I don't think it's a good idea at all. I've seen a number of analysts mention that earnings so far have not come in as bad as they thought. Also seeing many surprised that we haven't seen any uptick in employment yet. And unemployment, I think you mean. Could this mean we still have a soft landing? So listen, the pathway to the bad end of town goes through the good end of town, goes through downtown, goes through the bad end to the bad end of town. So if you're taking a trip to the bad end of town and somebody wakes up and looks out the window and says, well, we're downtown. This is pretty good. You said we're going to the bad end of town. We're not in the bad end of town. And you have to explain that, yeah, but this is on the way. So a soft landing, and all of the data of a soft landing is on the way down to a recession. You just don't go from things being really great to suddenly being really bad. It goes really great to pretty good to, well, this is not so bad. And then that's where we are right now. So it's not a matter of look out the window, where are we? It's where are we going? So right now we're in the soft landing neighborhood, but the vehicle is still driving. And if you look at all of the leading indicators, the trajectory is downwards. We're still driving to the bad end of town. It's just you woke up and looked around and said, this is not so bad. Maybe we're here. So since you have to go through this phase to get to the worst phase, therein lies the confusion that, hey, this looks like a soft landing. Yeah, as you're driving through the city, it looks pretty good on your way to the bad end of town. In Exhibit 9C of this week in earnings, why doesn't the sum of the 4 quarters add up to the current year total? I don't know. I've noticed that too, and I don't know. I think that one of them may be lagging and one is leading. So, for instance, this week, if you look at S&P, the S&P spreadsheet one seems to be a week ahead in terms of what the average earnings expectations are versus what this week in earnings are versus Lipper Alpha. So I think that it's that one is more current than another one. At least that's the only sense that I can make of it, because the earnings expectations have dropped again this week to 225.02, but last week S&P had that number. So it could be that the week in earnings number is lagging by 1 week, whereas the full year might be current. That's my best guess. Could not find the TOT futures contract in IBKR. I've shown it in a video before where I put up the screen and I've typed in TUT and there it was. If you're not getting it, it's either not allowed in your area or you're not allowed anything with futures. TUT is a ticker where the underlying are futures contracts. So you might not be allowed to trade futures. Can you please explain what you mean by there is 50 bases, 50 points of carry here and how that benefits you? All financial futures have an upward sloping futures curve, meaning that if you look at the S&P 500 futures going out a year, they'll all have higher prices. The futures contract will all have higher and higher prices because that is the cost of carry. If you are long a longer dated futures contract, you have negative carry because that interest rate will work against you because it's the underlying is carried forward at the rate of the interest rate. If you're short, you have positive carry in the sense that if I sell June futures for 41.40, but the index is at 40.90, the index can still rise 50 points before I lose a single penny because my price is 41.40. Anything below 41.40, I make money. So even if the index then just goes sideways, I will make the full 50 points, the full 50 points that are in the carry. So being short at high levels of interest rate, you have a curve that is in steep contango. You have the benefit of the positive carry. How can a retail investor turn their fixed rate mortgage into a variable rate mortgage with a derivative? That would be kind of hard because you're looking at monthly interest rate payments, but you could, in a broad sense, figure out what's the value of your mortgage and then find an interest rate underlying that you can take enough of a position in an interest rate underlying to equal the notional amount of your mortgage, such that if mortgage rates rose, you would make money on the derivative. But if mortgage rates dropped, you would lose money on the derivative. So that's the, you want to turn it into variable rate. Yeah, so if rates dropped, you would make money. And the money you make, you'd pay the higher fixed rate, but you'd make money on the lower rate. But if rates went up, you'd lose money, meaning that you're paying your fixed rate and you're losing money because you're going to pay a higher variable rate. Best thing to do is just go to your bank every couple of years and renegotiate and, just renew your mortgage. Close one and open a new one. What do you think about a long-term China short? Is it possible China reopening is a bit overhyped? Everything's a bit overhyped, yeah. Especially when considering some of the issues you spoke about July 17th market update. Well, the one thing China didn't have that the U.S. had is all of that COVID spending given directly to people, all of that free money that was handed out to people. So when the Americans got out of their lockdown, they had a whole bunch of government money that they could go spend. That didn't happen in China. So yeah, I think they're a little bit overhyped in that respect. But long term short, I don't know that I'd be there yet. Earnings yield will tell you the yield you receive on the current price. Exactly. Any growth in EPS would actually increase your earnings yield from the price you paid. Yes. So SPY earnings at 5.6 on current price. If EPS grows in the future, this earnings yield would increase from the current price you pay. Yes. If this is correct, this would factor in a slightly lower ERP. Am I correct in thinking this? Well, you're just looking at one side of the distribution. So let me say this. Let's say that I can give you 4.8%, and you're going to get 4.8%. No downside, no upside. Or I say, I'm going to give you 5.6%, but there is, a argument for upside, and there's an argument for downside. That's called risk. We don't know what it's going to be. There's no idea. You're going to get 5.6% based on the price today. That is the expectation, but we don't know. You could lose 30%, but you could get 20%. So you would say, well, I'm taking on risk. Yes, you are. You can get no risk for 4.8% or risk for 5.6%. In other words, you're saying, I'm only going to make an extra 80 basis points for taking on the potential of maybe losing 30% and maybe earning 20 or 30% over the next year. Yeah, you're going to get an extra 80 basis points for taking on all that risk, that uncertainty. I don't know. It doesn't sound like I'm being compensated enough to take on that risk, because it's not just, it could be higher, it could be lower. Is 80 basis points enough to get you to leave your house when the pack of wolves are outside? Right? You got to think about that. There's risk. So it's just a good way to think about how much you getting paid to take on a distribution of outcomes. How much are you getting paid to have an uncertain return over a certain return? I came across a claim that OECD's composite index of leading indicators for the U.S. Is consistently among the best predictors of recessions within a one-year horizon, but that this reflects data snooping. Who cares? Hey, this is the best predictor, but it's data snooping. Who cares? Who cares? All that means is that, look, I'm going to try to predict the future. So let me come up with a bunch of variables today, and I'll run a whole bunch of regressions, and I'll see what I can come up with. I can explain a data set 100% by continually adding variables. However, it's not going to travel very well, which means when I apply that model outside the data set, it's going to fail. So when it fits the model very, very tightly, or when a model fits the data set very tightly, we say it has low bias error. But when you move it outside the data set to a new data set and it doesn't work very well, we say it has high variance error. So what we're trying to do is get a model that has low variance error, which means that when we use it on different data sets, it has good predictability consistently. Well, when building that model, I may have tried a whole bunch of different variables to get to that. But it does not matter if I snooped around if I have a model with low variance error. In other words, it predicts very well, but hey, listen, I really tried like a whole bunch of variables before I came up with this model. Doesn't matter, still works. Still works, still has low variance error. It's still a good model. I think I'm going to leave it here because I got half an hour to get somewhere, and by the time I edit this and upload it, I got to run.